Good morning, traders and investor. Welcome to the #1 morning show to get you ready for the stock market open. Let's dive into today's topic. We're going to touch, of course, what should be on your radar going into 8:30 today, the economic data of the day. We'll take a look at what you should be watching, PCE, University of Michigan consumer sentiment. We'll talk about when is the next rug pull. You guys let me know what you guys think in the chat. We'll touch some earnings report. Of course, we got Apple, Amazon. We'll touch into the disaster that was Roku and Intel. We'll get into U.S. Steel, ExxonMobil, Proctor Gamble, Chevron, Phillips 66. And of course, we got our special guest, Michele Schneider, Managing Director at Marketgauge. I'm excited to go ahead and wrap up this week. Give me a thumbs up. Let's go ahead. Let's get it started. Welcome to Pre-Market Prep.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, traders. I'm excited to dive into today's action. It's one of those exciting mornings. Let's bring on Joel Elconin. Let's go ahead. Let's bring up those charts, my man Joel, and let's take a look at the futures action because today's the day. I'm calling it. I feel that the Bulls have the Bears by their hands, and today's the day. Do they get it back? We'll see what happens, but the pressure's on. The pressure's on the Bears today. Let's bring on my man Dennis Dick, and let's take a look at the futures action.
So
the market 26.25 handles, flirting with closing over 4,100. Strong close, and they just lifted offers after the Amazon numbers, and then they lifted offers after the Apple numbers, really ignoring any of the bad stuff that's out there, but we'll cover both sides of the market. Pre-market high, 0875, nothing up there, folks. We talked about the limited resistance on the daily charts, and there you are, 100 points away from that 4,200. Crude, that's having a good day. That's up 219, 98.61. Gold, once again, this is one of the best weeks gold has had in months, up 620, 1740. Silver flirting with $20, up 6.7 cents, 19.93. Bitcoin participating in the rally too over the last couple days. That's only down $50 at 23,875. And Ethereum, a little bit more down on a percentage basis. Down $45 at 1688. These are the futures that I'm talking about. Triple D, I sure hope you did not have many offers out there after the close, because if you did, you got lifted, and then they probably bid above your offer. What a buy fest.
it was, but you know what? It was selective. And I will say, obviously, Amazon, the catalyst, and we got Apple, and that added the fuel to the fire of, at least the fire for the Bears. But if you look and you get a better feel of what the overall market was doing last night, really IWM was flat. Now overnight, we've lifted on pretty much everything. But last night, it was very selective. It was tech getting bid, and other stocks were not participating. I'd expect to see a lot more rotation here again today. Whenever there's money flying into a sector, it seems like it's flying out of another sector. We're back to that again. I don't think we're in this everything bull market now. It's going to start to turn like it was a stock when the markets were going down. But it's starting to get more selective. You're starting to see certain sectors show a little bit of relative weakness. I mean, Proctor Gamble is going to probably hit the consumer staples here today as it's trading down. We'll get to that as well. But again, the big story of the day is going to be the big two, Apple and Amazon last night. And that Amazon move, not even so much the earnings, just the response to it. It's like, man, if you are short this market, you are having some trouble with these earnings.
Definitely. Now the question we start asking ourselves is, of course, when's the next rug pull? But let's take a look at these earnings and what we saw. First one up, it looks like Amazon. Let's get into it. Let's talk about the EPS here at 18 cents, beating the 13-cent estimate. Sales at 121.23 billion, beating the 119.09 billion estimate. Amazon did say the second quarter 2022 net loss included a pre-tax valuation loss of 3.9 billion, including non-operating expense for a common stock investment in Rivian Automotive. The CFO did say that they're questioning hiring plans, likely won't hire at the same pace in previous years. Let's talk about some important numbers. If you take a look here, Amazon Web Service came in at 19.7 billion, beating the 19.56 billion expected. Advertising at 8.76 billion, beating the 8.65 billion expected. And Amazon said that it expects to post third quarter revenues between 125 billion and 130 billion, representing a growth of 13 to 17%. And the expectations are for 126.4 billion.
So everything okay. That's what we'll just say. It wasn't like a blowout, but it was pretty good. And with the expectations and the getter for everything, and you get obviously, you know, the beat and the guidance seeming to be fine as well. They couldn't stop buying it, Joel. I mean, I'm long Amazon. Obviously, well, not me. My wife is. So basically, I'm long Amazon. So I give her some good ones every once in a while, Mitch. You know, I give her some dogs there.
I see you.
But every once in a while, you got to give her a good one. So
got to balance out the portfolio, man.
Yeah, we're long. What a move, though. I mean, I didn't expect an 11% move. I'm not sure what the straddle was. Maybe it was expecting just as much. We probably should have looked at that. But up 13, we're starting to leak off a little bit here. But it's a big move. Like, you'd think it was a real blowaway when you see an 11 or 12% move.
Yeah, exactly.
And it's like, it seemed like a good report, but it didn't seem like a great report. Doesn't matter. This honey badger market's just squeezing the hell out of the shorts.
Yeah, because I looked at it too, and of course, you know, they gave a guide, but it was kind of like, okay, well, what kind of guide? You know, we're looking for 126. We say 125 to 130. Whatever we think doesn't make any difference. What is important is the price action, and they bought the living daylights out of it. They're not giving it back. Pre-market high. You just gotta say 140 if you're looking for a longer term number. 139.39 is your after hours high. We backed off only a couple bucks from that. 140 just above that was the low before it gapped down off its last earnings report. So short term number, long term number, it's both. It's a question of when and if Amazon can clear this 140. And I'm not even talking about clearing it. I'm talking about clearing it, closing above it, putting a couple lows in the high 139 handle. That's it. But that's what I'm looking at for Amazon. One heck of a move. And I'm sure there wasn't that kind of move wasn't baked into the straddles. So don't have that platform.
And then jump over to Apple. We might as well cover them together because you had the move in the overall market in the Qs at 4 o'clock. And then Apple always comes out at 4:30. And you're just like, okay. You know, it's Apple, and then the earnings came out, and Mitch, how'd they do?
Well, EPS coming in here at $1.20, beating the $1.16 estimate. Sales at 82.96 billion, beating the 82.81 billion estimate. Apple sees Q3 Mac revenue 7.38 billion, down from 8.23 billion year over year. Wearable revenue down also 8.8 billion, down from 8.77 billion a year over year. Now, I did get a note here from Loop Capital Gene Monster, so definitely got to give him a shout out. This is based on what I believe, but what was the most important comment for the call? Cook's assessment in respect to the iPhone. There was no obvious evidence of macroeconomic impact during the June quarter besides FX. The segment grew 3% year over year. So weighing in with FX, this was actually pretty good results there for the iPhone. I know a lot of people were worried about the demand there. Now, the only area of softness that we saw really was in wearables. Home accessories are the ones that missed pretty big. They missed expectations by 10% and reported an 8% year over year revenue decline.
We're not seeing the slowing in demand and we're seeing in certain pockets, but we're not seeing it across the board yet. And to your point, Mitch, doesn't look like Apple is seeing it yet either. certain things, just people are going to buy them. You know, they're the last things they're going to buy. People don't want to give up their iPhone. They need an iPhone. They're going to do it. I mean, some things are sticky, and then there's discretionary purchases like boats and stuff that, you know, some people are like, okay, I'll lay off that. I did hedge my Apple going into the report. Still have the hedge on. Wish I wouldn't have, because it's up $4, but I don't know. I feel like there could be a rug pull here, so I'm a little bit scared. But at the same time, it's hard to be bearish this market when it just continues to climb the wall of worry. I mean, I tweeted out this morning, there's so many things we could worry about, you know, to obviously a little bit of slowing demand in pockets, but I mean, you know, we still have rising interest rates here. We've still got, you know, inflation, which is, you know, seriously, you know, if it's coming, I think we may have saw peak inflation, but you're still seeing prices go up at the grocery store. You're still seeing, even though commodity prices have come in, you're still seeing inflation in a lot of other areas. I mean, and then the whole China situation, which we can get into after, I mean, is a scary situation as well. I mean, Biden didn't have a call with Xi yesterday, but, you know, some of the stuff that came off that call, or at least what the media is reporting, sounded scary to me too. So, and obviously the war with Ukraine as well. There's still lots of things to worry about here. But this honey badger market just continues to climb the wall of worry. And, you know, to our point, you know, I got bullish, you know, a few weeks ago here. But I feel like I'm at a point that the market's had such a run that it's still prudent to be taking profits because I'm scared of the next rug pull.
Apple, just go specific to Apple here. Yeah, it got a boost. So this report a little bit more, you know, justifying the move up, right? I mean, you even got those comments that Gene alluded to. We don't see it, you know, the demand and for iPhones, everyone needs their iPhone. Leaked $3 off the high. 164 is a good level. It's a good level on your pre-market chart because that was your after hours chart because that's where it went to immediately. And then on your daily, you got 164.08. So I'd be using that as a target on the long side. Looks like it's starting to thicken up, though. It looks like the sellers could come down. They came down off 164. Let's see what we can do at 163. And then they're like, okay, we can't get enough done at 163. We're coming down to 162. And that's where they're at now. And now we'll see if it goes 161 offer here. Just a similar pattern. Kind of noticed this in Meta yesterday. Someone just looking at the 60-minute, this is when we talked about it on the show. It wasn't going through 163 in the morning. I mean, that was obvious. And then they jammed it down near the low of the move and rebounded. So
it bounced right where it had to, that 154 low. It held that low. So it bounced where it had to. But there is certain stocks, like we say, you know, buy the dip is hot again. And obviously in certain stocks that has been the case. But you have other stocks that, you know, are not coming back, like at least, you know, quickly. Obviously Snapchat, the dip has not even been looked at on that thing. You know, you had Upstart, the warning, that stock is still sitting down near the lows. There's certain stocks that are not coming back, and that brings us into Intel here. And Intel is an epic disaster here once again. They just seem to be clockwork that this company just finds ways to disappoint the street. I have no idea what they're doing anymore. It's been a value trap the whole time. I sold it back in that March rally, and I got lucky to get out of this one. I've obviously been hit on other stocks, but lucky to get out of this one because this thing is significantly lower here. Now at $35, it seems like they can't do anything right here. Mitch, tell us about the earnings report, and then Joel break down the technicals on the disaster stock of the day.
I tried to talk about it yesterday before at the close. It's just not sexy anymore. And when things are not sexy and they stop being sexy, well, stories can change. Intel Q2.
So stop on that point, and then we'll go into, because I want to just talk about that point. It's such a great point you're making, and you were, you know, a story stock investor. Like Mitch is good at finding the sexy story or finding what is the next sexy story. And I mean, when he says something is not sexy, he's absolutely correct. It's hard for a stock to turn around when it's, you know, and it's a good analogy. It's hard for a stock to turn around when it's not sexy. It's hard for it to just all of a sudden buyers to come back in and say, yeah, this is the turnaround story. IBM has struggled with this for a decade, you know, and Intel's going the same way. And I'm scared Cisco, CSCO could do the same thing here too. Some of those old school darlings from the year 2000 are just not the darlings anymore. I mean, Intel, we know, has AMD and NVIDIA have eaten their lunch and become the players, and Intel has fallen. So you can talk about the turnaround story here, but it's hard to turn the stocks around. They've tried, they're trying different CEOs, trying different things, but the market just, and it's to the point of valuation as well. I mean, even if the company starts to turn around, they're not going to give it the valuation that they give to NVIDIA or that they give to AMD because the story is just not sexy. So jump into that report, though, but great point, Mitch.
Let's do it. EPS coming in here at a miss here, missing at 29 cent, missing the 69 cent estimate. Pretty big miss there. Sales at 15.3 billion, missing the 17.92 billion estimate. So another big miss here. Intel CEO did say adjusted PC demand down to 310 million to 325 million. Down 10% year over year in its calendar year of 2022 from the previous outlook of 350 million. They see Q3 EPS at 35 cents versus the 87 cent estimate. Sales at 15 to 16 billion on the high side, and the estimate here on the sales for Q3 was at 18.62 billion. So definitely guiding down there.
Zozo Trader tweeted, Intel not inside. I mean, that's pretty much what this is now. Remember the commercials was always like in the corner of all these commercials, Intel inside. It's not inside a lot.
That's how much I don't know. That's how much I don't even know about this story, Dennis. That I don't
well, you're young. There's always the commercial back in the early 2000s. You'd have an Intel commercial, or you'd have a You'd even be on non-Intel commercials, and they'd plop in the corner. It'd be Intel inside, and everybody wanted an Intel. It's like now it's not the case. The consumer mindset has changed, and they aren't interested in Intel chips. I mean, and that's the
and there's a reason why, though, right? There's a reason why. I think there's the important thing too. It's the reason why is that they actually lack in performance. That's the real key here, is that they started to lack in performance compared to the AMD chips. And if you want to compare that, for a while, Intel used to kick ass over AMD, but then they started catching up. And once they caught up to where it was an equal player, AMD just started taking over the story.
We got a tip, $19.99. Kennedy, K. Kennedy, thank you very much. Says he enjoys the show and he's
coffee is on you, Kennedy.
We like that.
Cheers up. You know what I always say on live trading, pinky on up. So I appreciate you, Kenny.
Dennis, it was Intel and it was do. That's what.
Yeah, there you go. Joel's got the do's.
Yeah, someone put.
That's not there anymore.
Yeah, and then it would like kind of. Boy, oh boy. I own this. It's an epic disaster. Small position, even a smaller position now.
That's a good thing if you're a buy and holder, though. As your positions become disasters, they become a smaller part of your portfolio, and they slowly don't hurt you as much as they used to.
Exactly. Man, I was just looking at this. Way below the COVID low by $10 now, and I can just we talked about this one yesterday on At the Close, and I gave you, I said no chance of upside until we clear 40.70. Well, we can forget about seeing that for a while. We'll just go to the monthlies here, and you were at 34.38 in I mean, there's a couple monthly lows here. The where there's two of them is in the lower 33 handle, 33.23, 33.34. So beyond that, we're sitting on the lows of the pre-market session. So not much, little nibbling, sneaky buyer at 35, but I don't
been leaking.
Yeah,
it does. 35. You got the low, Joel. To your point, the July 5th low, 35.54. We're slightly below that, but we haven't traded through in the regular session. I mean, that's the bogey. When stocks are making new 52-week lows, you got to go. And that's right. They're going to challenge it here today. There's really no reason to be long Intel, at least from a trading perspective.
All right.
Yeah. If trading perspective, if you're short and you're thinking of bringing it in,
maybe. If it makes new lows on the move, makes me not want to bring it in. If
I know, short. Exactly.
It's been a tough story for a long time. Intel and IBM, you can group them together.
Yeah, it's been kind of a story that I talk about this often, and you just kind of mentioned it also with some other brands. There's a lot of these saturated brands that need to bring in innovation, and if they don't bring innovation, they quickly can get left behind.
And that's exactly what's happened.
Mitch, you made a good point too about with the pandemic, right? Everyone working at home, everyone needed to.
I was talking about this with Joel.
I need a new computer, right?
Yeah, everyone kind of front ran demand there, right? In the pandemic and coming out, everyone was at home, probably getting new computers in 2020, 2021, and 2022 comes rolling around, and then no one really needs a computer, really, because they probably already went and bought it. And also the prices have been going up and up on computer parts, so it doesn't make it easier to get a computer nowadays than, let's say, 2 years ago.
All right, well, let's look at a stock that makes Intel look like it's having a good day.
Well, let's go ahead. Let's take a look here. I will say
so
that
other disaster stock of the day.
They turned the TVs off because Roku's earnings definitely show that.
Wow.
EPS coming in at a loss here of 82 cents, missing the loss of 68 cent estimate. Sales at 764.41 million, missing here the 805.64 million estimate. Roku added that the advertising market would continue to suffer in the current quarter, that consumer spend would moderate, and which would, of course, hurt their TV selling and related hardware accessories. Roku missed on guidance. It said that it's going to bring in $700 million in revenue during the third quarter, well below the $902 million that was the estimate.
It's turning in, and we've said this before, a reason why I haven't liked Roku for a long time. It feels like TiVo. It feels like TiVo. You know, TiVo was a thing.
Oh man, you're comparing
it really.
them to
We've
TiVo?
said that. I've had made that comparison for 2 years. I made it wrongly as the stock climbed up all the way, and I didn't participate in it. But this does feel like it's the TiVo. This is, you know, the parts. It gets you streaming. TiVo was, you know, the original, you know, like, let's rewind TV. Well, then they put it into all the TVs, and they put it into every service, and all of a sudden you didn't need a TiVo anymore. I mean, your smart TVs have it all built in. Do you need the Roku? I mean, some of the Roku is being built into the TVs, which is good. But do you need the little boxes? I just bought 2 TVs, Mitch. They're for my new house. They're both smart TVs. I don't need Roku boxes for them. So I mean, again, TVs? To that point, what's that?
Are they Amazon TVs?
I don't actually know. They're not. I think I want Samsung. The other one's a Sony, I think.
Because I have 2 Amazon TVs and I have 1 Roku that's next to me. So
yeah, and some of the Roku is being built into the TVs too. But I mean, the little boxes, you're eventually not going to need any of the little boxes. So that whole business aspect, I mean, it's going to be competitive for them, and they haven't never really made money. I don't know if they ever have. I mean, the valuation's been nuts. You know, Kathy, one of her biggest holdings, if not one of her biggest, it'll be more. You know, she'll buy more here on this dip because she sticks to it. But I think she's wrong on this story. I think Roku could bounce. It's oversold. You know, we're just selling 20 points. They're in the buy the dip mentality here. I think when we look at Roku, though, 5 years from now or even 2 years from now, I personally believe, just my opinion, that the stock is much lower.
Can't blame you for that outlook.
Well, the bad news is it's down 1837, 21.5%. The good news is it's $6 off its pre-market, its after hours.
The buy the dip mentality is going to be in here, maybe. I would stay away from this one. I'd rather buy the dip in something else, but it might be in there, Joel. I mean, you're starting to see it come in. People are looking to buy stuff. This is just, and it could go back to 70, 75. It could. I just think the long-term story here, outlook, I just look at the competition. Do you need that Roku? I just don't think you need it.
Never had one. It just, you know, keep an eye on like the rebound people that scooped it up, you know, under, you know, actually got under 61. I would just say probably thicken up if you start to go back down, because a lot of people are thinking, boy, I wish I would have brought this in at 62 or 63 or 64. So I think you'll see some bids on the way down as opposed to this after hours just blitzkrieg. And your recovery highs.
What was that word?
Blitzkrieg. You've heard that word before.
Blitzkrieg?
Yeah.
You know this one?
Blitzkrieg? Come on.
What the heck does blitzkrieg mean? I gotta stop you on
Don't worry,
one.
Dennis.
Joel gets these words from the 1950s.
Intense military.
That's a World War II word, I think.
It's an intense military campaign.
Yeah, it's
intended to bring about a swift victory.
Blitzkrieg. We learned something new here today.
Yeah, there you go. There you
Okay,
go.
they know. This is from World War II. Mitch knew it too. So
Okay,
I know
all
this.
right.
I paid attention in history. Don't worry, I paid attention, guys.
Well, but I'm Canadian, so my Canadian history maybe didn't have Blitzkrieg.
So the big thing here, I think, with Roku is also focusing on what their strategy is, right? Because I think a lot of their strategy was first to try to get inside your home, right? That's why they put their devices out. That's why they put them inside the TVs. The second step, I think, really was them to try to turn into like a Netflix, where they could have original content and they could get it right into your TV, where you wouldn't even need to download the app. You would essentially have it already on your TV. And so that's the same kind of strategy that Amazon's using with their Amazon TVs, right? They have Amazon Prime Video. I don't have to ask my Amazon TV to show me Amazon Prime Video. It already shows me there when I turn it on. And so I think that's their strategy. The question, will it work, right? Will their original content start taking off? Will they be able to get the content that they need? And of course, we saw Netflix for a long time spending a lot of cash to get that content, to get them to where they got to. All right, let's get out of Roku. Let's get into, of course, some other news here. Let's talk about
PCE
U.S.
coming
Steel.
too.
I think this is an interesting one. Let's take a look at their earnings report. So let's go to X. I always say, X is going to give it to you. And it did. We'll take a look here. EPS coming in at $3.86, missing the $3.87 estimate. So just missed by a penny there. Sales at $6.29 billion, beating the $576 billion estimate. U.S. Steel surge on a 500 million stock buyback. So that's why it's kind of up. That buyback definitely gave it that lift here. It's one to watch. It's been pretty strong the last couple of days. I mean,
Everything.
In about we got 2 weeks. It's been up about 34%.
More even, Mitch. $16.41 the low, and you're trading at $22.65. So you throw you're 40% up here in a matter of basically 2.5 weeks. I mean, now you're chasing it. You got major, super duper for you, Joe. Resistance up at 25. That's $2.50 away from here.
Yeah.
But we've come a long ways. And to that point, I actually hedged my new core yesterday too, because I'm looking at this and you had the 180 all the way down to the 100. Now you've come back to 130. And I don't think it's getting easier at this point in time. We just had a 30% rally in new core in basically 3 weeks, or maybe 4 weeks, you could call it. 3.5 weeks. I mean, X, same thing. I mean, sometimes it's just good to just take the profits and run. Sometimes you can do different hedging strategies. You can write some calls. You can do some different things. But at a certain point, we've just had a pretty big move here. So, I mean, and we called it. So I think it's still prudent to just be taking profits. I know we got room to 420. We talked about that in SPY yesterday. Maybe this PCE number is going to come out and really go. Because if they start to show, it could in 2 minutes, we might see even more movement here. I just feel like I'm taking some chips off the table, though. We did pretty good, getting bullish here a couple of weeks ago when the whole world was bearish. But now the whole world's starting to turn a little bit more bullish, and there's still a lot of crap to worry about here. So I think the number could be okay today. I do think we saw peak inflation. I do think there's room to 420 on SPY, but we've got a big chunk of the move already. I think slowly taking chips off the table is still prudent here.
All right, let me go ahead and try to give those estimates really quickly here before we go wide on that. Do you want to maybe do that X text right quick?
Pre-market, I didn't really, nothing jumping out to me. 2280 is the pre-market high, and there was another daily high there, though. I don't have a great level for you in that one.
All right, so let's keep watch here. What's important on this? Of course, the number that the Fed watches, the core PCE price index. So you got month-over-month estimates at 0.5. Prior was 0.3. We don't want to see something come in like, let's say, 0.8, right? Core PCE price index year-over-year estimate is 4.7. Prior was 4.7. So there we wouldn't want to see something like, let's say, 5. We're going to watch to see what happens as this hits the tape. Also, don't forget today at 10 a.m., you'll get the University of Michigan Consumer Sentiment. The estimate is 51.1. Prior was 51.1. What you wouldn't want to see on that one is a number actually go down towards, let's say, 50. So keep that one on your radar. That's the University of Michigan Consumer Sentiment.
I'm going to go hide.
Time to go wide, baby. Go wide, Dennis. Go wide. All right, let's see what's going on here.
Yeah, I can tell you where there's resistance. 4108.75. That stands as a pre-market high. If we go into reverse here, I just don't know where to tell you support is, to be absolutely honest with you. We just ticked down. We just nicked that pre-market low. That previous pre-market low was 91 and a quarter. Boom, you caught a bid right there, moving back up mid-range. Psychologically, I think 4100, like, wow, when's the last time we've been at 4100? So little bounce dip, a little bounce. So not getting back into 4100 handle. That is a little bit worrisome here. Coming back towards under 4090. Really, the only thing you can look at is the top of the after hours range yesterday. That was 88 and a quarter. But the Bulls are making a stand here at 4090. What were the actual numbers there, Mitch?
All right, I got right now, I have the year-over-year number as 4.7, so that's good. That's looking good there. Looking at this right now, I'm trying to read actually as it hits the tape.
Okay.
Really just hit on. I'm on here. I'll give you guys the actual here, guys. If you guys want to take a look at the actual print here, I'll put it in the comments here for you guys to take a look at it. Also, I know the news are pulling it right now from this press release.
All right, seen it.
There it is here. I got June 0.6 versus the 0.5 estimate. Prior was 0.3, so it actually came in hot there, showing us that inflation not cooling off there, at least from the time being, from the PCE reading here.
All right. Basically, where were we
pretty
at?
much in line. This is kind of like very muted response.
But this to me isn't good though, Dennis. Even in line isn't good because inflation was supposed to show a topping, right? Topping action. To me, this isn't a good thing. I would expect to have seen it go underneath that estimate, and then that would have been good for the bulls. We would have been full rah.
You think eventually we're going to start to see some slowing in the data, but we're just not seeing any of it yet. I mean,
remember what Blue said, it sometimes takes a
time.
while.
Yeah, it takes time. I mean, not great here, just slightly, but it's right there. It's not like it's super high. It's kind of right there with where expectations were. So with that being said, I think, the market's just taking it in stride, and it went wide. Now it's like, well, it doesn't seem to be like a market moving event. We still could see, rug pull here. We could still see some stuff. I mean, S&Ps have leaked just slightly here, Joel. But
here's personal income here at 0.6 versus 0.5. Prior was 0.6, so kind of same reading there in personal income.
Just a little leak, slight leak. We're showing the chart on the S&P here.
Yeah, I mean,
we're waiting for the big move, but I don't think it's coming.
There's steady pressure here. To me, you got the pop. We were at 96 and a quarter before the number came out. They whacked it. The rebound didn't quite get back to that area at 832. So I think the bears are starting to poke around here. It's just hard to find support here because of that price action from yesterday.
All the price action from the last 3 weeks. I mean, we have had a hell of a move. And even take it back from 3 weeks. Just go to July 14th. 371.04 on the S&P to 408. I mean, this is a 400-point rally here in the S&P futures, Joel, in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 sessions. It's a huge move. We've had a lot. Like, if you're stuck in stocks, you've got a gift here. A lot of, if you were like 100% or all in or even on margin, you've been given a gift. This has been a nice rally, and we're not out of the woods. I like to think we're out of the woods. I like to still think the low is in, and I still think that's the case. But, are we going straight up and just going 420, 440, and 460 and going all-time highs? I don't think it gets easier at this point in time. That's why I'm booking some profits.
Yeah, and then just kind of to focus on here is what will the Fed comments be now, right? I mean, will we get kind of, we're not seeing inflation top. We need to kind of hit it harder. I think that could be coming. So I'm going to be paying attention to see what happens. Also, don't forget 10 a.m. University of Michigan consumer sentiment. If that trickles down again, showing weakness again, will that also bring us back down also? So 2 things here. Definitely going to keep watch. And the year over year came in at 4.8. Estimate was 4.7. Prior was 4.7. So it actually trickled up. This is not what I think everyone was expecting. I think to a lot of people, they have already thought that inflation's topped. but at least the data is not showing that.
So we're trying to tick red on the IWM. We're right there right now.
Joel, can
SPY's
you
doing
reshare
most of
your
it
charts
back.
for
It's
some
hard to
reason?
look at
Sure.
the S&P today because you got Amazon and
Yeah,
Apple
it's
that
yep.
are giving you the fluff there. The IWM is better. We're basically flat. So we've given back the gain here because Amazon and Apple are going to hold the S&P up a little bit. So, you can't just look at the S&Ps to go flat. But IWM is trying to tick red. So just getting back to scratch, trying to hold there at scratch. It's not a great number, but then they're going back, and you just think we've had some pretty good reports, or at least, the response to reports has been pretty good. And you've still got that buy the dip mentality out there. So it's hard to go rah full bearish because the bears, let's be honest, the shorts
Who's
are
buying
getting
the dip
squeezed
up here,
and they're
though?
caught.
I mean, come on, buying the dip. I mean, there's dips to buy, but I mean,
Yesterday was the dip to buy, but you see how vicious they are towards it, Joe. We get the dip off the open yesterday,
oh,
and we drop like about 30 S&P handles, and then all of a sudden they just start buying and they can't stop buying and they rip them again. It's been a tough market to be bearish, but it's a tough call here. Like it was an easier call last week when everybody was bearish, or 2 weeks ago. It's not as easy of a call here now. It's like, okay, we got a little more room to the upside, but now we got so much air beneath us here. It's just air everywhere. So it's like I go basically back to trading market neutral here at this point in time because we've had a big move, and I think there's a little more gas in the tank. So I don't want to go full bearish short, but I don't want to get caught either with the next rug pull. So that's why I still think prudent to just take some chips off the table. It's been a good move. We've had some good response to earnings, which weren't that great. And the whole China situation is still a big question mark, which we'll get to after our guest.
Yeah, let's go ahead. We'll dive into our guest right now. We'll take a look at definitely something that I'm looking at, and it just doesn't seem like there's any slowdown. I'm looking at kind of the month-to-month numbers, and it's not looking, at least from the numbers, what we're seeing in the prices. All right, let's get out of the core talk. Let's get into our special guest today. Let's bring on Michele Schneider, Managing Director at Marketgauge. Welcome back, Mish.
Hey, nice to see you guys.
help us make some sense out of this market here. We can talk about the modern family, or just talk about Q2 earnings so far. But just your reaction yesterday in the market, in the rally. I mean, are we out of the woods here, Mish? Or are we? I mean, everyone's looking for a rug pull that doesn't happen very often. What's your overall take on this rally? You getting cautious up here, or still more room on the upside?
Well, these are all great questions, and I was listening to your analysis before I came on, and I pretty much agree with everything you said. If it's a bit frothy, good time to take some profits. Not out of the woods necessarily, but that doesn't necessarily mean that we're going to be dumping. And getting into strength here, which could still be a bear market rally, could be dangerous. But let's try to really make it very specific in terms of the types of things to look at, and also the overall macro theme. So I know there's been a lot of play, recession, not recession, whatever. We've been saying stagflation for a long time. Mm-hmm. And I really do like to look at the 70s. In fact, the last time we had 2 periods of GDP down like this, and similarity in terms of what happened after with a 3-day rally, interestingly enough, was in the early 70s. And this has been the 70s show for us for a while now, in that we didn't have an oil embargo, but obviously we have the Russia-Ukraine war, which spiked up energy prices. And we do have a slowdown of economic growth. We have a lot of geopolitical concerns all over the world. And notwithstanding also what some of the stuff that could potentially continue to happen in the United States. And on top of that, we've had this out of control inflation in so many other areas. So I think that what we have right now is a situation where the Fed, obviously there's the don't fight the Fed thing, right? There's a few things you have to look at. Number one is you have to really look at the long bonds right now, the TLTs. And I'm just looking at them over here. So they're down a little bit. They were sort of teetering at around 119 in the TLTs, and now they're down closer to 117. I think that's going to be a real key for 2 reasons. Number one is because obviously if there's any kind of flight to safety in the bonds, where the bonds start actually outperforming the SPY, that's kind of a signal that things aren't all that roseate in the stock world. Number two is if they fall much further and let's say break down under 116, 115, what it's signaling is the yields, which are still really kind of low if you think about it, even with the raise by the Fed this week, are possibly could shoot back up. And that's not going to be great for the tech market. That's number one. And I don't want to talk too much in one shot. So if you have any thoughts on that, I can then continue, or I can just continue.
Please continue.
Okay. So the next bond market, just wanted that permission. Thank you. So the next bond market is the junk bond market to watch. It was the one thing that made us realize that the market had bottomed basically at the end of June, beginning of July. And when I say bottom, we don't know if that's the bottom forever or the tradable bottom, because the junk bonds actually also bottomed. And now why are they important? High yield, high debt, right? So this is where people go when it's a risk on environment. And right now, even this morning, as I'm looking, the junk bonds are up again. So they've had a tremendous move from the lows. So the question is, do they hold? So I would be looking at HYG around the 78 level. If it takes out 78, it's probably got more upside. So does the market. If it starts to teeter here and fall, particularly if you blend that with the TLTs, what the bond market is telling you is that, again, maybe we've gotten too frothy and a little ahead of ourselves. So those are the two things. And I just want to tie that into the macro, because what can happen in a situation, and this is what happened in the 70s, is commodities and equities can go up together. And then at some point when inflation starts to look like it's going to get crazy, and right now we have a Fed really more transparent than ever, telling us that they're fighting inflation more than they care about recession. They don't even think we're in a recession. That's when you'll start to see more aggressive action by the Fed. And that's when equities can fall, but not necessarily control commodities. So that's why I think right there, the bond market to me is the biggest key going. And a lot of people don't really know how to focus on that.
You know, you look at different periods of the market. It's been following there for a long time, and you try and make correlations. And I don't want to go into the whole redefining recession or whatnot. You had a pandemic. I mean, what's going on in the market right now with inflation and recession, non-recession. I mean, it's really hard to find a time that this correlates to. Can you I mean, it's definitely not a rampant inflation environment. Well, it may be like the 70s. I mean, what's the easiest comparison that you can make?
Well, I go back to the 70s, but there's some very big differences, obviously, because the labor market, I mean, to me, the labor market is probably the most interesting place to look right now. Because on one level, right, this is what the Fed's looking at. We had great numbers on the last unemployment statistics that came out. We have another one coming out in a week from now, by the way. So they'll be watching that. But it doesn't really tell you the whole picture, right, Joel? I mean, because it's not saying about the participation rate, that right now there are still over 10 million jobs available. And in the last number, more people started quitting their jobs. So I've been really thinking, what does this mean? And I kind of come up with the idea that it's in some ways a soft revolution. And that's really something that we're seeing all over the world, right? People are just sort of fed up with the shortage of food, government control, manipulation by the banks, et cetera, et cetera, et cetera. Manipulation of gold, as we're seeing with JP Morgan. And so people aren't going back to work, even though it defies logic because they need money, partly because they're like, I can't make enough money to buy stuff anyway, based on the cost of inflation, so why bother? And I think people are also staying home, hoping to become more in terms involved with trading, whether it's Bitcoin or the market. And number three is they're saying, you know what, the hell with them. Who wants to work anyway? Why should I keep this machine going, this machine that doesn't care about me? And that is, I think, an interesting thing to keep in mind, because that's really where social unrest, and we've seen it in pockets, certainly globally, but we've seen it in pockets here in the US. And that's why I think it's a little bit different and yet the same as the 70s. Because, right, what was happening in the 70s, there were protests like crazy, particularly the Vietnam War and then the whole Nixon thing. I go back to the 70s as the best comparison, but we still have some differences here, especially with the labor, because back then people were dying to get jobs and the unemployment numbers were much higher. Now people are like, who cares? I don't even want to work. And it's incredible to me, the mindset.
Definitely. The millennials, I won't even get started on that conversation, Mish. Let's take a look at the Fed outlook now, right? PCE coming in just a little bit harder than expected here. Now, what do they look at now? Do they change their rate of hike rates or will they just continue?
Well, Powell did talk about the PCE and he's very concerned about it. It was a very interesting speech. I actually listened to most of it on Wednesday. And he was really, I think, he's got this incredible calming voice, which is great for the markets. But if you listen to what he said, he was like, well, we don't even know what we're going to do. We're going to be data dependent. So this kind of data is really what's going to be in his mind. Next week, the labor reports, what's going to be in his mind. But he has been very clear that inflation is going to be his number one thing. So look what's happening right now. Gold could be finally waking up. We also have the grains coming back after a big dump. There's still tremendous issues all over the place in terms of Mother Nature. I mean, my God, did you see Las Vegas is underwater on the Strip? Kentucky, people have died there. And this is the crops. All of our crops have been really underperforming. So food inflation can continue. And this is the conundrum for the Fed, because even if they jack up rates to try to destroy demand, how do you make up with rates for poor crops or lack of energy globally, or a Russia that's basically thumbing their nose in terms of the oil and the energy markets? So I think that the Fed is going to continue to be aggressive, more aggressive than people think, because you're going to see that basically they're going to have not much choice, and commodities could go out of control, because certain commodities they can't control even if they raise rates unless they go, like really, really high. And they're not going to do that, especially in a midterm election where they could really put the skids on the economy, which of course the big talking point right now, as we know, is that things are fine. We're not really in a recession.
Mish, this is such a tough market because you can look at the economy, you can say, well, we still got inflation, we got rising interest rates, rising faster than we've seen in decades. You've got a war going on in Ukraine. You have political uncertainty really with the China-Taiwan situation happening. There's so many things that we can worry about here. And even to the earnings, they haven't been fantastic. But the market just seems to be at this point in time turned. It feels like sentiment has turned and we're like, just on this march of climbing the wall of worry again, which we've done over the course of the past decade. Are we back to just this climbing the wall of worry, or do some of these things eventually start to hit the stocks again?
Well, I love the expression that the earnings were not better than expected, but better than feared.
There you go.
That's really what's driving the market up right now, is everything's better than what we feared. Inflation, people still think it's kind of peaked. I don't, for example. The labor, they're going, okay. The Fed, all right, well, 2.5%, we can deal with that. That's where we were, by the way, in 2018. And we've already sold off ahead of that. So the market kind of priced that in. So right now, as long as things stay the way they are, we could continue to climb the wall of worry, which is why, going back to my initial conversation, you really have to watch both the long bonds and the yield curve. I mean, people watch that. I don't watch it as much, but that's definitely an indication. And the junk bonds, because that's really where you're going to see if there's a shift or if people are still going, everything's better than we feared, and we have more upside in the market. And we've been looking at around 4,200 as between 417, let's talk in terms of SPY, 417 and 420 as a really reasonable target. We've thought that all along. So we're not that far away. So let's see what happens. Do I think new highs, everybody jump back in the pool and everything's great again? No, because I think the Fed is going to have to deal with this. And also, I wonder, even though Apple and Amazon's earnings are backwards, they haven't priced in this new 75 basis points. It'll also be interesting to see what happens going forward. And I think the earnings were interesting because, believe it or not, the biggest iPhone sales that came out of Apple was from India and not necessarily in the United States. So yeah, to your point, we got a lot of potential bubbles all around. But if you just keep your eyes on those two areas in the bonds and watch retail, Modern Family, granny retail, right? So important. It is actually the lagging sector of the entire Modern Family right now. And even with the Apple and the Amazon earnings being robust, we'll see what it does today. But it has barely lifted its head above its 200-week moving average. And if that can rally and catch up, then yeah, I'd say we have more upside. If the retail sector, which by the way is the biggest component of GDP, right? 70%, we're a consumer economy. If that starts to falter along with the bonds, then you know this party is over and we're probably going to go back and test the lows at least again. And that's kind of where we're at. You got to be nimble.
Got to be nimble, like always, especially in this market when things can change on a dime. Appreciate you coming in today, Mish Schneider, Managing Director at Marketgauge, and we'll definitely have you back on.
Thank you so much. It was great to see you guys.
Appreciate it. All right, guys, let's keep it going here. We got some more earnings stocks to talk about. We just got the PCE to come in a little bit hot. How's the market looking right now, Joel?
Just hanging out, Joel. We're not doing much.
Just hanging out?
Yeah, we're hanging out.
Oh, he's on the mute button.
Settled in. Say we've settled in.
I think you clicked mute it. Just click it on the screen there.
Oh, Joel's on mute. He's trying to figure out how to unmute.
There we go. He's back.
We went down, we nicked the pre-market, we took out the pre-market low, but it was like bid. I'm bidding. And we just, it's hard to, figure out gaps. The wild after hours action, we made a high at 88 and a quarter. So from that, you filled the gap on the downside, at least in the way that I look at the markets. And now you're on the rebound up 19 handles. It's going to look at still going to look at like 96, 97 as a significant level because that's where we were before the PCE came out. So if the bulls want to get control, they're going to get it back up there and get it back in the 4,100 handle.
All right, let's go towards the black gold, the oil, baby. Let's take a look at some of these earnings stocks coming in today and starting it off really. ExxonMobil EPS here at $4.14, beating the $3.74 estimate. Sales at $115.68 billion, missing the $132.7 billion estimate there. Miss on the sales, but I don't think that mattered.
Just do Chevron with it.
Yeah, I'll do Chevron with it. I got you. Let me go ahead and throw up the Exxon numbers. I'll give you Chevron's numbers too. EPS at $5.82, beating the $5.08 estimate. Sales at $68.76 billion, beating the $57.96 billion estimate. And if we're just going to give them, let's just give Phillips too, right?
Sure.
I thought Phillips 66 was one to kind of catch here. EPS coming in at $6.77, beating the $5.78 estimate. So big beat there on EPS for Phillips. Let's go through them. Let's see what we see on these charts. I think this is something to talk about because we just saw PCE, right? We've been talking about is inflation peaking or not. Let's take a look at what oil's saying now.
The one play has been to be long the oil stocks into the reports and then selling them right after on the pops. Because we saw Valero yesterday absolutely blow it away. VLO, I don't know if we talked about it on the show, but it opened at the highs basically, and they just pulled the rug out from under it. And why is that? Because there's still a lot of people, including myself, that believe that oil prices could come down. And if that happens, they're at peak earnings right now. So is this as good as it gets for the oils? It might be. We're seeing nice pops in Exxon, Chevron here again today. I think there could be, I'd be careful chasing these for the simple reason that we've already seen the rug pull. So like I said, the play has been to be long the earnings, long into the reports. They pop into the reports and then selling those pops of the reports, not jumping and chasing them because the rug pull has been happening on some of these oil reports and they've been good.
Yeah, you took the words right out of my mouth there on that because I was thinking about the Valero, ExxonMobil. This is a big move, probably way over its average daily range. So nothing at 95.5 on the dailies, but that's where someone put a stake in. And so I'd look at pop up to 95. See if I can even open over 95. Same sentiment there. Maybe if you're looking, to take profits on this, and you think there's a lot more, it's going to triple digits, then make sure you get through that pre-market high. Chevron, same thing, stuck its head over 150, 156.50. Do I have anything on the dailies there? 156. So there's a little bit of a confluence with the dailies, and then PSX, same thing. That had to pop, and that's only up 61 cents now. So 90 is still a big level there. Any way you crack it up, that was yesterday's high was 90.08.
Do the 50% retracement just on your chart on CVX, Joel, because I think we're kind of right in there on the after hours action at least. So he's got his nice little tool. He won't make me do the error math, but we'll just do and we'll see what that takes us to. So he's got his fib tool coming in there.
It's higher.
157, but you could call it 156.5. We got a buck away from it.
Yeah.
So that's major resistance. Now you have a pre-market high that's almost coinciding with it, just above 155. So you're a buck or two away. No, well, 156. So you're a buck away. You got it from it. So I would say that's like your resistance point. And again, it's like this is always everybody's accustomed to 2020. You get these V bottoms. V bottoms are not normal. It's normal that you wave. So you got the move up or you got the move down. And then you get a little bit of contra rally, and then the next move is in the same direction here. And I think that's where we're in the oil stocks. And I'm still cautious, and I might be wrong, and I've been bearish and wrong oil for a long time, but definitely right in the last couple of months. I think that this rally is to be sold because I think they're at peak earnings.
I'm going to go and take the opposite end here. Like always, it's fun to have two sides of the market.
Sure.
I'm going to take the opposite end. And the reason why I'm going to take the opposite end is I've just been seeing how natural gas has been really affected by talks of Russia strong arming. And I think we could continue to see more strong arm and pretty much changing this to becoming an energy war. And I think this is really what it comes down to is, will there be kind of more pressure on the oil market? I know demand destruction is talked out there, but to me, I haven't seen anybody really kind of change their driving patterns. They're still going to work more than likely. They're still filling up the tank. Now, are they worried about the prices? I would say yes, but I don't really see a change in the patterns of driving out there. And it seems like the airlines, they're passing on the expense down. So I don't know. I have a feeling that we could get back up there. Are we going to break through new all-time highs? I don't think so, but we could stabilize above the 100 price point and maybe start making our way back. Let's see what happens. All right, let's get out of the ExxonMobil. Let's go to Proctor Gamble. Let's take a look at that one. I think it's an important one to touch today. Let's take a look. EPS coming in at a miss here at $1.21, missing the $1.23 estimate. Sales at $19.5 billion, beating the $19.37 billion estimate. And what did you see on this, Dennis, that kind of caught your eye?
It was interesting. The report broke about 6:58 Eastern, and the stock it wasn't great, but it was trading down around a buck, and it sat there for about 10 minutes. And then it's amazing how much influence CNBC can have, or major opinion can have. But the CEO came on at about 10 minutes after the report on CNBC, and the numbers were kind of mixed. And then Becky Quick was interesting enough, pointed out, she's like, well, she was looking at the guidance, and she's like, well, the CEO said he was impressed with his quarter. Stock was still trading down only a buck. And then Becky Quick pointed out, well, your numbers, Street was expecting this, and your guidance is coming in here. It sounds like that you're guiding down. And then he said that is correct. I don't know if he meant it that way, but he meant that the numbers that she was saying was slightly lower than what the Street expected. And when he said that, the algos took it that Proctor Gamble, the CEO, just said they're guiding down, and they absolutely, you can see right there on that Becky Quick number that's the big pink bar down. It tanked like 4 points in less than like 2 minutes, right on that. So I mean, it's amazing, like just commentary. I'm not even sure if he meant it that way, that they're guiding down, but he just meant that her numbers were correct that she was saying. So, which obviously looked like a slight guide down, and they hammered it on there. So I don't know what that means. They might continue to hammer it on it. With that being said, I think the consumer staples are not the place to hide. It's had a nice bounce, 130 to 148. I mean, it's come off the lows. This is not a place I'd buy the dip.
And they kept going at him. They just,
Mm-hmm.
Joe Kernan and
Oh, yeah, Joe Kernan was on him.
yeah, they just like they were like they both were on him, and then she
Becky
like
seemed to be pretty good, but Joe jumped in there too.
I
I'm gonna-
know they were
gonna-
like
I'm going to
like
point at why I think they were on them. A lot of that might have been because they saw the Heinz Kraft earnings report, right? I mean, look at Heinz Kraft. I think this is setting on up here. Actually going to be looking
That
at
dip
Heinz
got
Kraft
bought.
potentially.
That dip got bought. You could,
Yeah.
I mean,
It
to buy
got
the dip
bought,
is
but
back
I think
again,
it's setting
just
up. I
there's
think it's
better
setting
stocks
up
to buy the
though.
dip on.
You get PG, bad earnings, you get Heinz Kraft, bad earnings. Maybe it's just the value falling off the tape here and growth taking over. Who knows?
That for sure, Mitch. That's and why I was doing some hedging and some of my other stuff too. I hedged my Merck. I was hedging a few things because in an environment there, we go to a deep recession, they hit everything, but those are recession-proof stocks. But right now, it's risk on, so it's not surprising that some of these stocks are starting to come off here all of a sudden. Even on the reports that they're not, interpreting them as, you could have that report if it's a tech stock, maybe like, well, this was just fine. But because there's a risk-on market, Procter Gamble isn't the stock you want in a risk-on market. So that rotation comes in and affects that too. But we're going to the weekend. We didn't get a chance. Somebody asked about Alibaba. I'm very so I just want to quickly talk about the China situation. I'm very scared. Obviously, they're locking down. I mean, there's 4 cases in Wuhan. And they're locking down the country again. I mean, this has just been the issue with supply chain. Never going to start when they lock down for 4 cases. You're never getting rid of this. Like, COVID is not going away. So we got to learn to live with it. But China's still trying to fight it and not live with that. And that's why they continue to lock down. And obviously, you get different situations. But China stocks are getting hit here once again. FXI is down 3.34%. But there's also the concerns that this Taiwan situation is scary. That call with Biden, reading what the commentary was from that call, is scary as well. I mean, there was threats from Xi to the US saying, you play with fire, you might get burned. I mean, scary commentary here, and that's a whole nother can of worms that the market is not even looking at right now. But I think that's going to be the next big issue, is the political uncertainty between the US and China. Because if we start to have breakdowns there, then the supply chain becomes a complete mess.
Yeah. All right, I'm gonna let you finish up on that. Yeah, I gotta hop over PreMarket Prep Plus. Mitch, talk about the event real quick, and Triple D, I'll check in with you after the open.
Yeah, definitely. We'll talk about the event. Let's talk a little bit about that. But just to kind of mention and wrap up Joel's comment, Dennis' comments there. Yeah, I kind of agree with that. I think it's very bold to think that, but I think it's one of the things of doing that is just keeping your eyes that there could be future headwinds out there, right? And I think the important part there is that, there's still some tradable moments in between this, but we always got to keep in mind that some bigger catalysts can come in and shake up the market, especially when it comes to political pressures like right now we're seeing. It's going to be something to watch. Do the sanctions get pulled off? Because that could be another thing. That could be actually a positive catalyst, right, Dennis? If for some reason we were to make a deal with China and sanctions get pulled off and economics can rise, what do you think about that?
The whole situation with China is just scary, though, and that's a situation that is not being priced in at this time.
Uncertain.
Because we're all coming in and saying, inflation, Fed's going to get it under control. But if we have some breakdowns with the whole China situation, and obviously, this trip over there and, the politics behind it, and I hope the U.S. makes the right decisions. But the one thing you don't want, it's one thing to piss off Russia. It's quite another to piss off China, because our stores, like, okay, Russia, well, we're not getting as much oil and our oil prices go up. We piss off China? I mean, every single thing that we get in this country, it seems like everything is made in China, and people are addicted to their cheap products. So, I mean, we're not going to work for $2 an hour over here. So, I mean, if we start to, have a breakdown there, you want to see inflation. You'd see a hell of a lot of inflation if all of a sudden we had to start making products here. So, I mean, this is in North America. So this is the situation where I think the U.S. has to tread very carefully. I think they are going to do it. But I mean, if we start to get a political, uncertainty here between China and the U.S., that opens a whole huge can of worms. And the supply chain was bad before. it'll be really bad going forward. So, I mean, I think we got to be very careful there, but that's a wild card for the bears.
All right, Dennis. So what's coming up on August 18th that everybody should know about?
Yeah. So we're doing an event, PreMarketPrep.com. We've said it a couple of times here on the show. We'll continue to give you, obviously, if you're interested in this, we do have a discount code for the listeners there, PMPP10. We'll get you 10% off there
PMP.
for all of our avid listeners. We want you guys, in there. We're going to teach a whole bunch of different stuff, teaching different strategies, stuff even revolving around the open. But, so we've always focused, on my personal trading, I focus a lot on day trading. We talk day trading, talk long-term investing, but swing trading is a big aspect of my trading as well. And, and getting positioned, and stuff even like, using relationships and like what Michele Schneider talked about today, and using, I like the TLT. She uses the HYG as an indicator. I mean, there's so many different things you can look at to tell when the market is really turning. When you catch these turns, and I'm, this is my bread and butter, is catching turns, you can really, you can really extract some nice alpha. So, I mean, so we're going to talk about all this stuff. Obviously, we're bringing Spencer back just for the day. We reached out to him, and he's like, just to come back in. He hasn't been doing that much, so he wanted to come in. So he's going to host it with us there. And Rob Friesen, who was my mentor for a long time, is going to be there as well. So it's August 18th. We're doing it during the day for once. We were doing it on the weekends before, but we're doing this one during the day, 12 to 3. You can sign up at premarketprep.com.
Sign on up, guys. I know I'll be there, so you guys don't miss it. If you want to learn a little bit more about swing trading, be there. I'll see you guys in just a few seconds on live trading. Dennis, have a good one. Have a great weekend.
Have a great weekend. Everyone
we'll
have a great weekend. Mitch, great job as always. You were rocking and rolling this week.
Getting better. Trying to work.
I gotta tell you, it's scary when you lose somebody but Spencer, but Mitch, you're doing a fabulous job. Keep up the good work, buddy.
Appreciate it, Dennis. All right, let's go ahead. Let's get into live trading that's coming on next. Yes, guys, we got a special live trading. Don't go anywhere. We don't have we're not going to give you some interviews. We're going to give you some trading action. So please, guys, smash up the like, guys. If you guys have been enjoying the content that we've had recently on Benzinga, we had a great show today. We talked a lot about these earnings from Apple, Amazon. We touched some oil names. We touched U.S. Steel, Proctor Gamble. We had a great guest on, Michele Schneider. If you guys missed that interview, I would definitely rewind and catch that before you get to your market open, as she pointed out some great stuff in the bond market. Let's get you guys over to live trading now, and definitely smash the like, hit the subscribe button down below, and if you hit that bell, you'll be notified the moment that we go live. Appreciate you guys staying with us. Like always, I'm going to try to improve every week. I know that I've made some mistakes with some pronunciations, and sometimes maybe I get a little dyslexic and I say the Heinz Kraft instead of the Kraft Heinz. I'll tell you one thing. I'm catching my mistakes and I'm going to get better. That's all we can do. Like my man Ryan on the next show says, 2% better every day. I'm going to keep working for you guys. You guys do me the favor. Give us the appreciation if you guys enjoy what we do, and hit the like below. We'll see you guys on live trading coming on next. Let's keep pushing.